Hey, what's up, everybody? Welcome to Pass the Money. This is Kirby. That's Alex. I always get it confused. But anyway, um, today we want to talk about the mortgage rates and where we're at right now, what part of the economic cycle that we're in. Remember, again, this is a channel just talking about financial literacy, trying to get people to understand and make sure you share and like this video because we're just trying to get more people to understand the real. We don't want this to be one of those, hey, we show off what we have and hoping everybody just get enamored with the things that we have and think that's what you should do. We want to give you the real life situations that we're in so you can use this information to learn to move forward. But with all that being said, we want to talk about the interest rates. We want to talk about how it's affecting the economy, how it's affecting us as investors, and moving forward with that. With all that being said, Alex, what you got?
So you just recently told me off of this channel that you got a interest rate at what 4.8%. You negotiated it down, which is like unheard of right now in this market. So who, who did you pay off to do this?
All right, right. Well, first off, let's understand where I got lucky at was I locked in the rate, don't you know, right there in that June, July. So in June, the rate went up to like 6%, and then it dipped for a little bit. And
Hmm.
then everybody thought, oh, rates was about to go down. I actually locked my rate in there, and there it was like 5.9. And then I went back to the lender and I said, hey, can we pay down this rate? And then I was already paying like 20 or 2,800 or 3,200, I can't remember, to get it at the 5.9. And then rates jumped again. And then now we're close to north of 7.75. And then they, ran the numbers again. And we got it down to four. What did I show you? 4.85 or five?
4.8, right?
Yeah,
4.
4.85. Yeah, 4.85, and I paid the extra 2,100 bucks for that 4.85 rate. But that was just because they wanted to do the deal. They know how much I'm in the industry of rental, and I'm not a huge of a risk of defaulting. So if those things wasn't, part of the game plan, then they wouldn't offer me that option at all. So that was just one thing that I tried to do.
Yeah, it's interesting because like I was thinking about it too. Like if you pay just that $2,200 up front, right? Like that point was that point or 1.1% difference over the long term is going to make a huge, it's going to be way more than $2,200. So you're really saving yourself thousands and thousands.
Right. And the thing was when it was at 5.99, my mortgage actually payment would have been about 1150 a month. And then when I brought it brought it down to like 947 a month. So that $200 difference takes about 10 months to break even on what I paid, 10, 11 months to break even
Yeah.
on the difference that I paid. But it was worth it to me because I plan on holding this property for a very long time. So and it brings me more cash flow, and I can pay down on principal if I want, or if not, just put more money in my pocket.
Yeah, exactly. This house that I just got, the interest we got was 5.472%. So about 5.5%.
Right. Yeah, and that's a decent number, especially now. Especially now, that's a good number, especially what you see in 7 to 7.5 going on right now. And and the thing that I want to push out to the people that's getting new into maybe investing or owner occupying properties or buying properties, 7.5%. Yeah, it looks steep. And I just got off a call right before we got on the video with somebody I know that lives here in Florida and looking to relocate down to Texas. And at first I gave an explanation of how I was thinking, but then I just broke down the numbers and I just said, look, if the amount you're paying in mortgage now can correlate to what you will pay in Texas, and I believe the housing prices are still stupid high in Texas, then go ahead and do it. Even though, and I explained that I only follow the numbers, and I didn't want to make it seem like, oh no, you can never move. Just understanding how the market works and how this interest rate works. If this person sell their house for let's say $400,000, let's just say $400,000, they got $100,000 in equity, and then they go buy a $400,000 house in Texas, yeah, they can put 20, 25% down on that property. But because the interest rate they have now is 3% compared to what they'll have in Texas now at 7%, if they have A1 credit with 20% down, then they're going to be paying more on a month-to-month basis.
Right.
And that's the part that I was trying to get them to correlate and understand, because that is going to be the big thing. The interest rate now is going to affect a lot of people on many different fronts.
Yeah, they had asked me too if I wanted to float the rate, and like the following week is when the rate shot up. And I just before I like when they gave me the option, I was like, oh, that's cool. But then I was like, you know what, screw it. No, I was like, just lock it in. Like I don't want
Yeah.
to risk. Yeah.
Yeah, when you dealing with rental properties, you never want to float the rate. If you want dealing with owner occupied properties, you never want to float the rate either, unless you're some sophisticated investor that got something going on that they know that they're going to flip it right back within, a year or so. But I still wouldn't recommend it there. The burst strategy, I wouldn't recommend it in this environment either, because even if they got, let's say they got the same property you did, and they was trying to do the burst strategy. And let's just say all things not equal, let's just say they was going to stay in their house. They was going to buy that property that you got, and then they was going to rehab it and then put a tenant in there, then refinance it. So you got it at five and some change. They refinance, the interest rates go up to 7.5. They try to refi it, then the refi to take their cash out. The property is not going to value as high as it was when you bought it, or it's going to probably the appraisal gonna come in about the same rate because of the interest rate, and then you won't be able to take out 80% loan to value or 75% loan to value to get your money out of it, because you're going to be paying a higher interest rate. So that would squash the birth strategy right there. So people, I believe, doing the birth strategy right now, unless you're very sophisticated, then I think that's a strategy that I wouldn't partake in at all. And then we pivot to what's going on. I think, and the interest rate right now, we at 7.5. That's what I showed last night, and that's what we seen when we looked it up yesterday. The people that I think that's going to be hurting bad now is, remember, everybody's talking about recession coming. I don't believe a recession. They will announce a recession. Technically, a recession is two consecutive quarters of negative GDP, which we already had the first 6 months of 2021. But of course, in the media, they saying, "Oh, we're not in a recession because the job rates are too low." I don't believe that the news media, the mainstream media, will announce a recession until after the midterm elections, because, of course, this is a political environment, and they don't want to go into the midterm elections saying, "Oh, we're heading to a recession." That make people pivot and change the people that they're voting for. But after the midterm elections, so January 2023, I believe they will start talking the um, recession rhetoric, and more people will go into fear, and then the economy will draw down, job losses and things like that. But because of the high interest rate environment, the people that I think will be affected the most is people who lose their jobs. So let's say husband and wife is in the house, and they took advantage of the low interest rates back in 2020, 2021. They got 3.5s and 4% interest rates. One spouse lose their job. Back in normal times when people was holding 6% interest rate, and then the interest rates came down and one person lost their job, then they can refi it for a lower interest rate. But now they, if one person lose their job in this scenario, if they try to refi it, they try to refi because they want a lower mortgage rate. If they try to refi it, the interest rate will be higher. So in turn, they won't be able to refi because then they'll be paying a more higher payment. So the things I believe will happen in that situation, it will be more people trying to sell their house if they can't afford it, if the job market collapse, like we've like we've seen in previous recession. So that's the thing that I believe those people are stuck in that situation. As far as the buy side, people that's buying, if you're buying now, then you still, let's say you buying at 7%. It's extremely high. I agree. But and if you can afford the mortgage payments and you have that cushion to weather the storm in case you lose a job or something like that, and then you move forward and then the interest rate drop, you can refi to get a lower rate. But those people that's at the 3 and 4, it will be damn near impossible for them to refi to get a lower rate because their rate is already low. So they're restricted to the limits that they're already in, and it looked good when we was in a high employment rate and interest rate drop. Is great. But now if a job loss come and then people come into a financial situation where they have to find a way to cut costs, refi is not an option for them, especially with the inverted yield curve and the higher interest rates.
Well, guys, if you liked the video, don't forget to hit the like button, hit the subscribe button, leave a comment down below, and we'll see you guys in the next video.